US inflation kept falling in August. All eyes this week will be on US non-farm payrolls on Friday for more clues about whether the Fed goes 25 basis points in November or another 50. Australian lending data today may show another rise, and consumers in New Zealand are more confident about house prices and their own finances. That's coming up in our 5 Things in 5 Minutes. And in our bonus deep dive interview, ANZ's senior commodity analyst Daniel Hynes looks at why Saudi Arabia might be about to swamp the market with extra oil to win back market share.
If they did revert to that market share-driven strategy, then we would ultimately see all of that low-cost supply flood the market, higher-cost producers out, but we would certainly see significantly lower prices than where we are at the moment.
But first, in 5 and 5 with ANZ, the market's focus turns to US jobs figures at the end of the week after US personal consumption expenditure prices data on Friday showed inflation in line with expectations and headed for 2%. ANZ senior strategist David Croy is looking for signs of a cooling US jobs market.
Markets are expecting a similar result to last month, 140k gain. And if you look at what's been happening to US payroll growth, it's been slowing all year. All of your 3-month and 6-month moving averages have been gradually declining. Obviously, it's still above zero, so the jobs market's not going backwards, but it's just not keeping pace with population growth. So, the US needs to turn about 150 to 200,000 jobs a month just to keep up with population growth. So whenever it's growing below that level, the jobs market is slowly unwinding.
Number 2, the key question remains, will the Fed cut 25 basis points or 50 basis points in November? Markets are leaning towards 50 right now, but David says that view is vulnerable to jobs and inflation data showing more resilience than expected.
At the Fed meeting last week, Fed Chair Powell basically said that there were a number of data points they were looking out for, and he singled out this payroll release and the next one, which will occur before the November meeting, as data that they'll be watching. So 100%, if we see that number come in, a little bit stronger than expected, then that will give the market cause for pause in terms of, how much easing is priced in.
Number 3, in Australia, the focus today is on private sector credit data for August. It rose 0.5% in July. ANZ economist Maddie Dunk expects a slight slowdown in August.
We're expecting in August it will grow 0.4%. And one of the reasons we're expecting this slowdown is due to an easing in the pace of growth in personal credit. So in July, we saw that personal credit jumped up to its strongest monthly number since August 2023. And I think that you're likely to see a bit of a pullback there.
Number 4, tomorrow in Australia, we get data for building approvals and retail sales. Maddie is expecting 0.4% growth in retail sales in August, rebounding after a flat July.
We saw a flat result in July, but that came after a few months of pretty strong growth. And there are a few reasons we do expect to see a boost. One is because we do know those stage 3 tax cuts are coming through along with other cost of living relief. Now, our ANZ Roy Morgan consumer confidence measure didn't suggest that we're going to see a significant uplift there, but you might see a mild pickup. And the other thing too is that households are increasingly price sensitive at the moment. Money is tight and they're thinking very strategically about how they use their money. And in August, there were a number of sales events.
Number 5. In New Zealand, consumer confidence improved by 3 points in September, which was its 3rd consecutive rise. Also, consumers' views on house prices have perked right up. Here's ANZ New Zealand chief economist Sharon Zollner.
So that was another interesting development this month. We saw house price expectations lift from 2.8% to 3.2%. That's not a big increase, but when you look at it on a chart, it's pretty clear that it suddenly changed direction. It was falling pretty fast, actually, and in the last couple of months it's turned right around and lifted again. So households don't tend to be able to tell you with any accuracy what the rate of house price inflation is or is going to be, but they absolutely get the turning points and the cycles right. So this is just another indicator suggesting that the property market has noticed the fact that rates are falling, and although house sales are still quite weak and prices are falling, that's probably going to change pretty soon.
Sharon Zollner there. Now, in our bonus deep dive interview, ANZ senior commodity analyst Daniel Hynes looks at why Saudi Arabia might be about to swamp the market with extra oil to win back market share. It has sacrificed some in recent years while limiting supply to try and wean its economy off oil a bit.
They've been able to reduce oil's share of total revenue from about 90% some 10, 15 years ago down to about 65% just recently. But despite this, their reliance on the oil price going forward continues to rise, in part because of the huge amount of spending they're doing to try and boost investment in the country and entice other industries in there. And so from our calculations, based off IMF data, that price that's required to balance their budget, including all of that investment, has risen quite significantly. In fact, we calculate now that it's around about $85 a barrel. Now, that's obviously quite higher than where current oil prices are, and I suppose raises the question around whether they will continue to restrict supply to enable prices to sort of hit those levels.
So how come the Saudis might be thinking about increasing their supply?
They've sort of dabbled with the idea of regaining market share because certainly holding back supply has enabled other producers to come into the market, like the US oil shale producers. And maybe there's a realisation that holding supply off the market is not going to push prices higher. And clearly that's been the issue over the past 6 months. So ultimately, if they can push more supply onto the market with prices where they currently are, then clearly they'll get more dollars through the door. They've got a relatively low level of debt and they have a fairly robust amount of foreign reserves that they can certainly dip into at the moment. So they could potentially withstand, the lower prices in the shorter term. But certainly it's something that's going to play a pretty important part in where the oil market heads, not just over the shorter term, but I think over the medium to longer term as well.
And how much spare supply could the Saudis pump into the market?
OPEC itself has about 6 million barrels a day of capacity, sitting offline at the moment. So clearly, that if that were to be reintroduced to the market, we'd see a significant build of inventories and prices would clearly collapse. Saudi has the most of those, so they certainly have the tools and levers, to increase supply quite significantly. But I think that would be that worst case scenario if they were to, I suppose, tackle or strive for that market share sort of strategy that they once had, and certainly would drive out a lot of those higher cost producers. But you would see oil prices suffer quite significantly if that ended up being the case.
You've mentioned this idea of another market flooding strategy. What was the last time they did it?
I mean, ultimately, what these oil-dependent nations are doing is maximising the return they get on their investment in the oil industry. And in the past, that has been a market share-driven strategy where they try to dominate the low-cost supply in the market. And certainly, countries like Saudi Arabia can produce oil at about $10 a barrel, significantly lower than where some of the other producers, such as the US, sit at the moment. So ultimately, by flooding the market, they could push out those producers. That was a strategy they tried unsuccessfully back in the early 2010s when the US shale producers started to emerge, and they flipped to that more price-driven one where they're obviously holding supply off the market to boost supply. But if they did revert to that market share-driven strategy, then we would ultimately see all of that low-cost supply flood the market, higher cost producers out, but we would certainly see significantly lower prices than where we are at the moment.
But you're saying they're not likely to go for a full market flooding strategy, is that right?
Yeah, I think that is certainly a worst case scenario for them at the moment. Clearly, producers that they tried to push out previously, like those US shale oil producers, are pretty sticky and can withstand oil prices below cost of production for a decent amount of time.
Daniel Hynes there. That was 5 and 5 with ANZ for Monday, September the 30th. Catch you tomorrow with the latest on China's PMIs. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.